Okay, great. So look, you're all very welcome to today's Smart Financial Moves webinar. My name is Sarah Connolly. I'm the marketing manager here in IPF. And today's webinar is going to be focusing all about financial planning, not just looking at your pension, but your overall view of your finances, and for both you and your family together. Okay, so look, it's great to see so many existing clients on the call here today. You're all very welcome. And just for anyone, I suppose, who hasn't been maybe at one of our webinars before, we'll give you a little bit of an intro of who we are. So IPF is an Irish-owned brokerage, okay? So we've been in business over 30 years now, working with public sector clients. So we have a team of 70 financial advisors at the moment, all who have a great background in public sector benefits. We run the payroll facilitated ABC schemes, which I know a lot of you are probably members of. And we now have over 30,000 clients on board with 1 billion in funds under management. So a figure we're very proud of here. We also have a lot of reviews there on our Trustpilot. If you'd like to go over and have a look at them, great to get so much good feedback from our clients. Look, today's webinar then is going to run for about 40 minutes. Okay, now the chat function will be closed for most of the webinar. We might open it up a couple of times just to get some feedback. But if you do have any questions, if you'd like to speak to an advisor after the webinar, we'll be putting up a link where you can book in a 5-minute phone call, completely complimentary, and you can have a chat to an advisor and see then would a full financial review be something that would be worth looking at. Okay. We'll also at the end have a little quiz. So there's a €100 one for all voucher available. And the answer to the quiz will be somewhere within the webinar. So keep an ear out, okay? So just to introduce then our speakers. So first up, we'll have Ellen McRoy. So Ellen is 15 years in the company, Ellen, this year, is it?
15 years and counting, Sarah. Yep.
That's it. So Ellen is a senior financial planner, but she's also one of our regional managers here. So she is also looking after some of our more junior staff day to day. Not to mention that she's a great singer as well. So you never know, we might at the end do a little song, Ellen. And also then today we have Neil White. So Neil is also a regional manager here in the company, as well as being a certified financial planner. So the top end of the qualifications you can get in the industry. So and Neil's with us 11 years, Neil, is it?
11 years, yeah. 11, yeah.
Yeah, plenty of experience and a wealth of knowledge between you both.
Not a good singer though. That's I'm here 11 years though.
But yeah, okay. So look, without further ado, I'll hand it over to Ellen just to have a look at the main objectives for today.
Great, thank you, Sarah. That's very encouraging to see such a high level of interest in the topics in the webinar. So thank you all for joining, folks. Look, some of you may have attended previous webinars that we've run around, retirement, investment, or just a general group meeting. And what we're hoping to achieve today, folks, is for everybody here, because this is very, very specific what we're going to talk to you about, is to just stand still and take a snapshot of your own situation. Now, we're talking from a financial point of view, so it's just really to kind of tune into what is financial planning as an entity and why is it important to everybody sitting here today. So you're going to hear a lot of talk around goals, objectives, financial planning, and this is kind of the financial advisor's language when we're speaking about these things. But I think the main thing is, folks, when we're looking at this, financial planning really, it's all built around your structure, what you have in place. Like, how do I make money? How do I build my money as I move through my life? Who is relying on me and my money? And how do I protect my money against downturns or something coming at me that I hadn't expected? So the good news is, look, the benefits that you have in place are really strong and really, I suppose, fruitful for most people sitting here today. So what you have in place is really important to look at as a foundation. And then we layer that up with, look, what pressures are on the income, the salary, what you have in place, and how can you create that financial security. Financial security, really, folks, what that means is it's freedom. Freedom to make those key decisions that you want for you and your family, that you have enough money coming in to pay the bills, you have enough money to replace your income if you get sick, you have enough money to replace your income when you get to retirement, and that you have a really strong structure. So we can all sleep well in our beds at night knowing that that security is under the bonnet of our lifestyle and our family unit. So again, it's really important for everybody sitting here today, tune into what's important to you. Not all of this is going to be relevant, but what we did find, guys, is the previous webinars were very pension heavy. It's a crucial part of the financial journey, but while you're getting there, it's really important to have the stepping stones in place to create that lovely financial freedom that we all want for ourselves. You'll see on each of the slides, guys, there's a QR code. The QR code, again, some of you, hopefully most of you, will get a light bulb moment throughout the webinar. I need to talk to Neil or Ellen or Sarah about that topic. I need to look into this a little bit more. I'm not sure where I stand around these things. So click on the QR code, and then it will bring you to a questionnaire where you can pre-populate any questions, queries, concerns that you might have. So I think, Sarah, we're going to open up the chat function for this slide. And I just want to get, I suppose, the juices flowing, people thinking around financial planning. Look, guys, what's your own idea of a financial plan? If you can pop it into the chat function. We have that open up there, Sarah, yeah?
Opened up there, yeah. I think everyone's just giving it a good bit of thought.
Give it a quick food, yeah. There's no wrong answer.
There's no
No.
wrong answer. What's your idea of a good financial plan? What do we need to be thinking about when it comes to our finances? Saving and security, planning for the future. Excellent. Future security, save for future in an affordable way. 100%. Investments. Excellent. Perfect, loved ones. Structure, comfortable retirement. Like, there's no wrong answer. Have enough to go through day by day. Planning financial goals. Protecting family. I mean, these are great answers, guys. And there is no right or wrong answer. Income protection, having money, financially retire at the age of my choosing, short-term, long-term financial goals. What this highlights to us, guys, is that financial planning and goals is different for every single person on this call. Everyone has different priorities at different stages in your life, but a very, very simple definition, and thank you for engaging in that, is a strategy for managing your finances and meeting your life goals. Okay, so you hear a lot about goals from, you know, financial advisors in general in the media. What does it mean? My goal could be, I'm going to get married next year. My goal could be, I'm going to buy a house in 5 years' time. My goal could be, I've just had a baby. I need to put a plan together to educate them in 18 years. My goal could be, somebody mentioned it there, having the option to choose to retire early and having the finances around that. And why is this important? So when we're looking at this, I suppose, what we're trying to do is future-proof ourselves against common pitfalls. So debt is a huge milestone around all of our necks at some point in our life. So we could have a mortgage, we could have car loans, things we're trying to pay down. And backed up with that, we don't have any savings in the background. So if something comes at us, the car breaks down, the roof caves in, we've no emergency fund in place. So how can we avoid those pitfalls? How can we achieve financial milestones? So one of the biggest decisions most of us make in our life is to purchase a home. It's a huge undertaking. So again, that needs a little bit of planning around it. So the planning could be since when we, start in college, what do we want to work at? What kind of income do we want to make? All of that needs planning. Our education is huge. And then planning around retirement, because if we purchase a home, we're planning to retire at a certain age. We need to have all our debt paid down. Peace of mind. Peace of mind is huge. And the amount of times I speak to clients or potential clients around, what do you have in place? I actually don't know. If something were to happen to you tomorrow, if income was to go, what do you have in place? I really don't know. I'm not sure. And that's a very, very common theme we get week in, week out. So it's actually knowing what is in place. Is it sufficient? Are we happy? Are we not happy? If we're not happy, how do we put a plan around that to future-proof our income and our loved ones? And then the next piece as well is that, we're all busy running around working and paying down debt and building up education funds and having, protection in place for the family. But actually, wealth creation is something that, we really need to focus in over time to build a strong financial foundation for your future. That could be any way, guys. That could be saving money in the bank, the credit union. That could be, you know, we're investing in our education. That gives us the income that we need to, you know, pay all of these key things for our family. That could be we're planning for our retirement and we're building up a fund that's going to give us the income we want when we stop. That could be investing our deposits. That could be we inherit money. How do we keep that ahead of inflation? So there's so many strings to this. So again, back to what is important for everybody here on an individual basis. So if we move on to financial planning, how does it work? So there's our lovely Saj, who works with us as a financial planner. And the first thing we talk to our clients about would be understand your goals. Again, everybody is different. So I know for myself, I want to retire at the age of 60. I want to make sure mortgages are paid down. I want to make sure my kids are educated and they're financially standing on their own 2 feet. That's my personal financial goal. Neil might have a financial goal that, you know, he wants to purchase another property, again, wants to pay down debt. Or I want to, you know, make sure that kind of future families are catered for, there's enough income coming in. So around each of these specific goals, we need to gather the financial data. So what's your current situation? Current situation could be, I'm earning 50,000 a year. I have 10,000 in the credit union. I'm hoping to buy a house in 5 years' time and I'm building that fund up. This is the pension pot that I currently have. This is the, you know, protection policies that I have in place. So we gather all of this financial data and then we start the analysis. So the analysis could be, okay, Saj, you have 20,000 sitting in the credit union. Now, if you stopped work tomorrow, is that going to be sufficient to pay all the bills for the next year or so? And if we're running short, okay, would it make sense to build a solution around that? Or I want to retire at the age of 60 and currently I'm on track to have a pension of 367 euros every 2 weeks paid for me for as long as I live. But I know in the background, I want to have a nice lifestyle. I know my monthly spend is going to be more than that. So I need to build a bit of a plan around that. So it's getting the forensics of actually what's in situ versus what do you want to see happen for yourself in all of these situations. This is where we develop a personalized plan with the advisor. So it could be my pension plan. I need to start building a solution around that. Or if I get sick, I need to make sure I'm replacing my income. Or God forbid, if I pass away, my income is supporting the whole house. I need to make sure that's replaced. And then also, I'm very good at saving and I'm building all these funds in the background, but the banks are not giving me any return for my money. So what's the plan around that? So how can I improve on that situation? Then we pull the trigger on the strategy. So implement your strategy is a very fancy way of just saying, okay, you need to put a pension plan in place, or you need to protect your income. You need to put a critical illness or a salary protection in place that if you're out of work in the morning and income stops, you can replace that. So again, what is the strategy? Is it manageable? Is it affordable? And then you review it. As we all know, folks, over time, things change annually for all of us. Salaries change, situations change. There's years we have more affordability, years we have less affordability. And the biggest pressure zones we find is, you know, you start work, you earn your income, the pressures start being added. So you buy your house, you develop your family, and all of that comes with a cost, or you get married, or you take on the purchase of a car. All of that puts weight and pressure on income coming into the household. So we need to review and adjust this over time. Okay. So again, just in terms of all of these areas, like, have I ticked all of the boxes in terms of my own personal situation? Now, the good news is superannuation scheme for most of you sitting here today is really strong and really good. So the benefits attached, and some of you know this already, are your pension. So you're due to receive a pension at whatever age, you know, you're planning to retire, dependent on the scheme you're attached to. So that pension is there. It's income, it's paid to me for as long as I live, and it's taxed, okay? The lump sum then that I get from my employer, I get that as a one-off tax-free when I retire. So the key parts here and the key questions are, is my pension going to be enough to sustain the lifestyle I'm used to? What outgoings will I have when I get to retirement? And is this going to cover everything that I need? And even if it's just about keeping the house lights on and paying the bills, folks, what do I want? Do I want to have a nice lifestyle in retirement? Do I want to be able to go on a couple of holidays a year that I'm currently doing? Do I want to be able to upgrade my car? So it all links into what is it everybody here sitting today wants to see for themselves. Then we move on to, whilst we're getting there, if something happens to me, I have a benefit in work that's going to pay me and sustain me for a certain amount of time. When that, and if that stops, what is in place to replace that? If there is an ongoing issue. And if I have looked at what I have in place through my employer and it is sufficient, we don't have an issue, that's brilliant. But if there is, and it's not going to keep the lights on, it's not going to cover the rent, the mortgage, then we need to look at a solution. Equally, we look at what happens if I pass away, which is my death in service. And like that, very strong benefits, folks. But 6 times out of 10, when we analyse this, it's not sufficient to cover the pressure on the household, the pressure on the salary. Again, we're looking at replacing income. It's all feeding into keeping everything ticking over and going. And then finally, we spouses and children benefits. So really good protection for families, for households, that if I pass away tomorrow, that there's a subsidiary pension paid to my partner. And then if I have dependent children, there's a lesser pension paid to them up until they get to an age where they're going to be financially independent. So again, really strong benefits there, but we need to analyse each and every one of them. And if we can tick all of those boxes, folks, we are financially secure. Now, moving on, are you financially protected? So the things we would ask you to ask yourself would be, do you know how much cover you need? And do you know what cover you have in place at the minute? Again, when I'm sitting down with clients and teasing through all of these issues, a lot of people say to me, well, sure, I have life cover. I have, the life cover on the house. But that's great. Mortgage protection covers the banks if something were to happen to you. Do you know how much your husband or your wife might have through their employment if something were to happen to them? What cover do you have? Because there's strong benefits in the public sector, but is it the same both sides? And then we find sometimes we need to rebalance the scales. Could you pay your bills if you were out of work due to long-term illness? So again, what's my monthly spend? If my income was gone in the morning, are we in trouble? So if we are, do we need to put a plan in place around that? And linking back to, do you know how much cover you need? So that's really, really specific for each household, and it all depends on who, what, and how relies on your income. And it's very, very important that there's a clear structure. So you are very, very clear in your own head what it is you need and what you have in place. So if we move on to creating financial security for your loved ones, because again, the previous webinars would have been very kind of pension heavy, like what do I need when I get to retirement? But if something happens on that journey whilst getting to retirement, all the plans can go out the window. So again, it's to make sure that we tick all of these boxes. So typically, the amount of cover needed will depend on your own individual situation. So a very general level of cover for families would be, okay, take on a mortgage. So I'm going to make sure that if I pass away in the morning, that the banks are cleared. So it's decreasing mortgage protection, declines in line with your mortgage, and usually cheapest chips to take out, folks. Okay, tagged on to that would be, okay, mortgage is gone if I pass away in the morning, but actually I still have my childcare costs, I have my food, I have my heating, I have my home insurance, I have all the extracurricular activities that the kids are doing. So there still needs to be a stream of income coming into the house to cater for all of those. So again, what is my main scheme going to pay out? And typically, and again, revenue benchmark, annual income is 4 times your salary, usually is the recommendation. And then if we're layering this up, we might have an income protection policy in the background as well for illness, or we might have an annual income for serious illness cover that will pay out once my salary takes the pressure off if I develop a really serious illness that I could, put a lump off my mortgage or just have available money that I can take a breather, step back and cater for the time when I need to get through when I'm not well. Things to consider, again, current situation. What do you currently have? How will they pay out, guys? And when will they pay out is really, really important. So if you have a plan that, is not going to meet the monthly bills or is not going to cater for your kids right up until the age of 22, 23 or 24, might only have a 10-year plan in place. That's not going to sustain them up until they're financially independent. We need to maybe look at a restructure. Do they cover you both? Do they cover you, your partner, your husband, your wife? And do they have an equal amount of cover through their employment? When does this cease? So are we overshooting the mark? Like, do we need to extend our cover right up until the age of 80, 85? Or actually, are we okay when we retire because our debts are paid down and our kids are financially independent? Again, case by case basis. And then sometimes we find that we sit down with a client and they're overcovered. They're paying too much for cover. And they might be able to find better value with an alternative provider. All of this, folks, is to get you thinking and get you thinking of your own situation. What is it I specifically need? Okay. Now, one of the biggest assets we have throughout our working life, actually, it is the biggest asset we have, is our income. Because if our income stops, everything stops. Mortgage, monthly bills, childcare, everything feeds back into income that we have coming in to feed all of these financial plans. So income protection, it's a replacement policy that will cover up to 75% of your salary if you're unable to work due to illness or injury. So say, for example, Neil goes off on a skiing trip and breaks both his legs and he is unable to work. He has an income protection plan that he might trigger, and that will cover 75% of his salary. So enough to pay the bills, keep the lights on, take the financial pressure off until he's fit to return to work. So if we look at what illness benefit would you receive from your main employment? So typically you have 100% pay for 3 months from the public sector. Then that halves to 50% pay. Okay, so we take a jump down. And then for most scenarios, social welfare rate of pay comes from the state through the state illness benefit. Okay, so currently it's 244 per week. So if it's a case, even after the 3 months, and then we drop to social welfare rate of pay, if that is not enough to keep the household going, pay the usual bills that are coming at you on a monthly basis, and we're in trouble, we need to look at a plan, folks. So again, it's looking at, I suppose, case by case basis. Typically, the closer you get to retirement, you might have built up enough credit in the public sector that you may have an option to be retired on ill health grounds. So there's no need to take on a policy such as this. But what I would say is, this is again based on Aviva's average stat on their claims. The average duration of claims is 6 years and 9 months. So if you can imagine, you would imagine the more kind of day-to-day injuries or illnesses could be, you break your leg or you hurt your back or whatever, but the average claim is keeping people out of work for 6 years and 9 months. So again, food for thought, 3 months full, 3 months half, social welfare rate of pay. If you're on that for a long duration, guys, that's going to put pressure. It's going to put pressure on the household, on income in general. So again, protect the salary, biggest asset that you have, cover yourself. Just another kind of stat as we move on to the next slide there, Sarah. Again, interesting in terms of the most common reasons for long-term sick leave. Our top one is mental health. It's stress-related illnesses. And I know a lot of you working within the public sector, dependent on your occupation, some of you are working in very, very stressful environments. So 27.5% of Aviva's claims came from stress-related illnesses. Okay, musculoskeletal, so that would be the likes of, back injuries, neck injuries, people working in, physical jobs like your physiotherapists, nurses, doctors, etc. Cancer is another, high one on the list for claims. And then you have your neurological heart conditions and then all others. So again, food for thought. if we look at the average age when first claimed, if we look at 60 plus, we're out of the danger zone by and large, okay? 18 to 24, very, very little claim history there. Our danger zone, guys, is between 40 to 60. That's when the most amount of claims are made. But if we look into kind of the 25 to 39, that's growing every year as well. So the importance of looking at these plans, getting onto the plan, covering yourself when you're young, when your premiums will be, you know, very affordable to take on, but also when we're in good health. So the importance of getting onto a plan when we're in top condition, and then if anything comes at us throughout our working life, we have full comprehensive cover for this. So again, it's just interesting, the stats. And again, these are not our stats. These are actual claims, live claims going on an annual basis. But again, the importance of tuning into your own financial situation and how this would impact you. So I'm going to pass you over now to my co-presenter, Mr. Neil White, who's going to talk to you around savings and goals.
Lovely. Thanks, Alan. So yeah, I suppose I'm going to speak on savings now, and I'm going to talk a little bit about, I suppose, when we sit down with clients, which we do on a daily basis, we get to the part of the fact find where we ask them, look, are you saving on a regular basis? And in fairness, Irish people by nature are actually quite good savers. So people will answer, yes, I am saving. And we'll follow it up with another question as to, look, could you talk to me a bit about, you know, what your goals are for that saving? And they're saving X amount, and their goals could be varied, be it, you know, children's educations, I want to change the car, Christmas, you know, I want to go on holidays. So there's a varied amount of goals. And then when we talk about where they're saving, they oftentimes don't understand that, I suppose, your saving goals need to align to the correct savings vehicle. And what we do in simplifying it for our clients is we break it down into your short-term goals, your medium-term goals, and your long-term goals. And we help clients understand that, look, your short-term goals oftentimes are the likes of your holidays and Christmas. And what you should be doing with your money in those goals that you have, or for those goals, is the current account is perfectly sufficient, okay? The next would be your medium-term goals. And what medium-term goals are to oftentimes is, you know, a house deposit. I'm looking at buying a house in the next 5 years. So the things that are going to happen in your life in the next 5 years, being it buying a house, or maybe changing the car, for example. But then also an emergency. I want to make sure, this, we hear this all the time, that I have money there in the event that there's an emergency. What's advisable to have in the event or for an emergency fund is typically somewhere between 3 to 6 months of net income. The next set of goals really are your long-term goals. So things that are going to happen, but may not happen for another 5+ years. And they're the likes of children's education. You may want to upgrade your home in the future, or the big one then is retirement. And oftentimes what happens is that our clients will have all these goals and aspirations, but they're using the same vehicle to I suppose, get to that goal. And that vehicle is a deposit account. And it may not be the right thing to do. And you may, for the longer term, you know, goals, need to look at the likes of a savings or an investment plan. And why people need to look at that or an investment plan is that they want to ensure that the money that they're saving for a long period of time, be it children's educations or moving home, as we spoke about, is that the deposit rates that are there currently are negligible. So they're going to get very little for money that's going to sit there for a long period of time for a goal that's not going to happen for another 5 or 10 years. And what's going to happen in the background while those deposit interests are poor is inflation is going to start to eat away at the money that they have sitting on deposit. What is inflation? We hear a lot of speak on inflation. It's quite a common theme. Basically, inflation is the increase in cost of goods and services across a particular year. And then when it comes to your money or your euro, how much actually purchasing power that has. So if inflation is increasing, your purchasing power is going down. Or if you're looking at goods and services, inflation is increasing, the cost of your goods and services are going up. The next one would really be, as I said, the cost of living increases. So people want to ensure that in the future, that if they have aspirations of things they want to do, be it get building work done in the house, that's not going to get any cheaper. They need to ensure that, I suppose, they're keeping in line with the cost of that building work and how it's increasing. And then lastly is that people have been working long and hard, and they have money sitting there and it's standing still and it's not working for them. And that's why it may be in your interest to look at the likes of a regular saving investment plan. And I suppose if we look at this here, I think this it gives a really good overview of how inflation can impact on those savings over a 10-year term. And if we just take a moment, even what was common, and I noticed it from the comments section, was that people said children's education or securing their children's futures was a big thing. And Zurich Life did some research, and I think the average cost for education for a 4-year degree is somewhere in the region of 35 to 40,000, okay, currently. So if we take it that inflation, which is currently about 2 to 3%, if you take, not just core inflation, everything's getting more expensive, about 2-3% per year. So your child's education costs will do the exact same thing. So if your child is planning on going to full-time further education in 10 years' time, and you're thinking, I'm going to save away and get to my 35,000 euro mark and have enough to put them through college, unfortunately, the cost of that education is going to be more likely, as we can see in the left-hand side, 50,000 euro. Okay, so that is really just how inflation will be silent in the background and impacting your money without you really realizing it. Another thing we would sit down and we talk to clients is that they've worked really hard to build up 50,000 euros on deposit or in a savings account for their future, be it maybe a gift to their children. They want to help them with a deposit. And they think, brilliant, I'm going to have that money there. That 50,000 euros in 10 years' time, if we look at the blue column on the left, the purchasing power of that 50,000 will buy 37,500 euros worth of goods. So it's impacted either in it getting more expensive or the purchasing power. And that's why the planning aspect of savings is so important, and ensuring that your financial goal that you have, you're utilizing the right vehicle for the particular goal that you have. And again, keeping around the theme of education and children's education costs, this slide or the next slide really exemplifies how you shouldn't have to do all the hard work when it comes to saving for your children's education. So this is a slide that was prepared by Zurich with actual figures over a 17-year term. So typically speaking, children are getting ready to go to out of second level education in and around 17 to 19 years of age. And if you were to save €100, 40 euros a month of the children's allowance over that period of time, you'd have approximately 30,000 euros there for their child, for their education after that 17 years. Which seems like a good, habit, and it is a good habit to have. However, you're potentially leaving returns on the table or a higher value by not, I suppose, putting that 140 euros into the right vehicle. And in a vehicle there, example would be the balance fund from Zurich Life. If that 140 was invested over that period of time, the pot would be 62,000. So as you can see there, if we take inflation, and the two slides kind of, correlate, it will keep in line with inflation and beat it a little bit as well. Or if you go for the balance fund, which is just to explain, is a multi-asset fund with mixture of stocks and shares and bonds, which is, a lower risk asset class, medium to high risk. Whereas the other fund on the right-hand side would be the international equity, which is 100% stocks and shares. So what your advisor will do is, oftentimes people want to ensure that they're comfortable with the level of risk that they're taking, and that they're happy with where their money's invested. We'll do a risk profile questionnaire to align you to the most suitable fund, be it balance fund or be it international equity, and we'll steer you in the right direction to ensure that what you're doing is helping you achieve the financial goal that you have. And I think taking advice is just so important in that area. So as you can see, the QR code is there. If that's something that jumps off the slide deck to you, be sure just to request a call back on it. So then a little bit about next is around tax reliefs, okay? So there's any amount of tax relief that is available to individuals, but we're not always familiar with what it is or how to go about it. And what I would ask or tell everybody to do is to familiarize yourself with the revenue.ie website and my revenue, because on that are lists out all the various different tax reliefs that you can you can avail of, but also how you can claim tax relief as well, and a step-by-step guide on it. But some of the common ones that are there is that you can get remote working tax relief. So you can claim up to 30% of the cost of your vouched expenses. So what that means essentially is heat, electricity and broadband for the days you're working at home. Now you might be thinking, Neil, how in God's name am I meant to figure out how, all that? Well, Revenue have a simplified calculation that you can follow. So how many days you're working at home versus how many days are working in the year, and they'll be able to figure out from that. So tuition fees, so this is a really important one and not something that oftentimes people are familiar with. You can claim up to 7,000 euros per year of approved degree costs. So if you have children going to third level education, you can claim up to 7,000 euros of their degree costs. However, you need to bear in mind that the first 3,000 euros for a full-time course is exempt. Okay, that's a really important one to note. But again, the revenue website explains all that. However, if you have your youngest is starting third level education this year and your fees are 3,000 euros, okay, but next year you have their brother or sister joining them, then you're up at 6,000, then you're in a position where you're going to be able to claim relief on it, okay? The next one, which we see all the time, is 20%. You get tax relief on your health expenses and people don't do it. So be sure to keep your receipts and be sure to claim your relief back. The next would then really be our more recent ones, which are your rent tax credit. So if you're a renter, you can claim up to 1,000 euros as a single assessment as a tax credit, or mortgage interest tax credit for those whose interest rates have increased over that period of time. Now, with these reliefs, okay, all these reliefs that are noted here within reason are backdated. So you can look back over 4 years of your income to be able to claim those reliefs. However, one of the most common forms, or the best, in my opinion, maybe a little bit biased, tax relief available in Ireland, and one I was at a webinar on Tuesday that actually is the most underutilized in the country. If anyone would hazard a guess as to what the most underutilized tax relief is pensions, basically, okay? So people do not utilize their revenue allowance when it comes to their pension. So you can get up to 40% tax relief on the contributions you make to a pension. And the thing with it will be is that every year your allowance, as you go over certain age milestones, will increase. So as we can see here, the older you get, the more you're able to put into your pension. Now, just as Sarah alluded to earlier on, there was going to be a question at the end of this, and this is quite relative, so not to give it away. But unlike those other reliefs where you have 4 years to look back, you only have 1 year to look back on your tax relief on your pension. So effectively what it means is up until October of 2025 of this year, you can claim against 2024. And once it's gone, it's gone. So you have 1 year to claim for tax relief on your pension. So be sure when you're sitting down and you're reviewing your financial plan, you're taking the advice of the financial planner, that you don't end up leaving tax relief on the table that you will regret when you get closer to retirement, okay? So I suppose that's kind of giving you an overview of savings. That's giving you an overview, as Alan went through, around life cover and all the rest of it. But why do people sit down, and why do public sector staff sit down with us? So there's an array of reasons, and I think they all flow into the common themes of this presentation, in the sense that the people have concerns, or potentially have concerns, around the shortfalls in the main scheme benefits their employer will provide them. So there is really strong benefits, and what we do as financial planners is we sit down and we help you stress test them against what's already in place. And our common theme here: if it's not broken, don't fix it. But what we'll do is we'll sit down and we'll look at it. So for example, some of them there are, if you're the main earner in the household, there's more pressure on your salary, you might need to look at protecting your income. You know, you need to make sure that there's been changes in your life events. You need to maybe adjust the policies you already have in place, and right through to the likes of your spouse. A big one is that the spouse oftentimes may not have as strong benefits in place as the public sector employee. And it's something that they need to look at and sit down, and we can do that and help them put the plans that they need to have in place. And as I spoke a little bit earlier on around savings, making sure that the savings that you're doing is in the correct vehicle for the goal that you have. And then the kind of last couple of ones then is not prepared for the future education costs. So what all this means really is, and I think a lot of people on our call today will, I suppose, have engaged in the process when it comes to financial planning, and they've started off maybe with their pension and they've taken on the advice. But the people that do the best out of any financial plan and find themselves in the best financial position when they get to retirement, or their families in the best financial position if unfortunately they don't get to retirement, are the ones to take on the advice and listen to the advisor and have their annual reviews. And it's not just me saying that, and it's not just me harping on about it. It's actually fact. In a recent survey that was conducted by Brokers Ireland, people found that they had 45%, it was shown that there's 45% larger pension pots when people sit down and take advice and review their circumstances. Then a big one would be they have 71% and there's more in their saving than investment plans. And you can see that clearly in the slide relating to the child's education costs. If you saved €140 a month in a deposit account, you're talking negligible return. 30,000 euros and put into that balance fund is going to have a value of about 50 to 60,000, which ironically enough is 71% higher than it would have been if you left it sitting there. So it shows you the power of advice and taking advice. 52% greater financial protection. You're financially protected for events that we hope never happen. But unfortunately, as myself and Ellen have had conversations on the phone with people, I suppose it's a tough conversation to have if they're going through a very difficult time. But the bit of solace is that they do have plans and policies in place that will ensure that they can, I suppose, focus on getting better and hopefully focus on getting well and returning to work when they feel comfortable and ready to do so. And people are twice as confident about their financial security. So I suppose that's all why taking your annual reviews and following advice is just so important. And I think, from the presentation today, I hope it brings some areas that you feel you want to have a further conversation with a financial planner on. So look, moving on then, what happens next? So look, the presentation gave you food for thought, things to look at, things to consider. But what happens next is one of our financial planners will be in contact with everybody, okay? So they will give you a phone call, to drop you a text if they don't get through to you. But if you want to kind of skip the queue and arrange to get a call back on one of the areas, fill in the QR code there. And what the advisor will do is have a 5-minute conversation with you and take the conversation, even if it's just to ask a couple of questions. They'll ask you how you found the presentation. But then if there is areas that you want to follow up on, you'll be able to avail of a complimentary consultation where, as Ellen said earlier on, what the financial planning process is, we'll assess your circumstances, make a recommendation and show you how you can put it in place. If there's more than one thing that we find you need to look at, don't panic and think, well, I have to take 2 days off work to go through all this stuff. We work in a multi-call process. So we'll take it one piece at a time. We'll look at your pension or your life cover, your income protection, your savings. We don't overload it. We take it one thing at a time. And again, I can't implore you enough to take that call, have the conversation and follow it up with a consultation where it's necessary. But look, that's all from myself anyway for this part. And I think now the next is the question.
Thanks for that. My favorite
No
part
problem.
of it always is at the
Yeah,
end.
this is the good part, yeah.
Yeah, and Neil was very generous to everyone. I think there he dropped a few
Probably a
hints
little
about what
too,
the
yeah,
question
in
might
fairness.
be. But yeah, we have a lovely €100 all for one voucher ready to go. So the chat function is opened there. So the question is, how many years can pension tax relief be backdated for? So if you want to throw your answers into the chat function and the first correct answer will be there. Well, you're all listening very well. Brilliant.
Great answers.
There you go.
Whoever the winner is,
so
you could, yeah, it was.
yeah, the first one I think I can see is Joseph Devons. So well done, Joseph.
Well done,
So
Joseph.
the answer was 1 year. Okay, so well done, Joseph. That's great. And we'll get that out in the post to you. Okay.
Fantastic.
But look, thanks a million, and thanks a million to our two speakers. That was brilliant. Some great information there for everybody. We will be sending everyone an email tomorrow. So if you didn't get a chance to fill in the QR code, we'll also put the link in the email tomorrow. You can complete it and we can get you booked in for that 5-minute chat with an advisor. We'll also have a bit of an information booklet and just some other little bits and pieces in the email, as well as a recording of today's webinar if you'd like to watch it back. But yeah, thanks a million, everyone, and have a great
Thanks,
day.
everyone.
Thanks, folks. Have a good day. Thank you very
Bye.
much.